Hello everyone, Blake Anderson with WealthGuard Advisors here. Today I want to talk about one of the most popular option strategies on the internet right now. It's called the wheel strategy. And if you spend any time on YouTube, TikTok, or option trading forums, you've probably heard someone say, it's low stress, it's consistent, you can make 1% per week selling options. So the question is the wheel actually a smart strategy? Or is there hidden risks that most DIY traders don't fully understand? Let's break it down. The wheel strategy is a very simple concept. It has two steps. Step 1, sell cash secured puts. You pick a stock you wouldn't mind owning, and you sell a put option below the current price. That means if the stock stays above your strike price, you keep the premium. If the stock falls below that strike price, you may be assigned the stock. In plain English, you're getting paid to potentially buy the stock at a discount. Step 2, sell covered calls. Once a cash secured put has been assigned, you sell a call option above your cost basis. That means if the stock stays below the call strike, you keep the premium and the shares. If the stock rises above the strike, your shares get called away at a profit. Then you repeat the process. That's why it's called the wheel. And I understand why it's popular. The wheel feels attractive because it generates premium income, it's structured and repeatable, it works well in sideways markets, it feels safer than buying calls, and it sounds like a paycheck. A lot of people love the idea of getting paid every week just for selling options. But here's the part most people miss. The wheel is not a low-risk income strategy. It's actually a stock ownership strategy with option premiums laid on top. When you sell puts, you are doing something very specific. You are selling insurance against the stock dropping. And that works great until the stock drops hard. Let's use a simple example. You sell a put and you collect $200 in premium. Sounds great, but then the stock falls 20%. Now you may be sitting on a $2,000 loss, and that $200 premium barely makes a dent. That's the truth. Premium comes in steadily, losses come in chunks. The wheel tends to work best when the market is stable or slowly rising, volatility is elevated, you choose high-quality stocks, and importantly, you size positions conservatively. But it struggles when stocks gap down, the market turns bearish, investors chase high-premium junk stocks, or too many positions get assigned at once. This is where DIY traders get into trouble. Now let's talk about that big marketing promise. You can earn 1% per week. And it doesn't sound a lot, but compounded, that's over 60% a year. To achieve that consistently, you need aggressive strike selection, high volatility, big assignment risk, and you'd have to accept drawdowns along the way. So the truth is, yeah, you'll probably have weeks where you earn 1%. But you cannot treat this like a guaranteed weekly paycheck. Option income is not risk-free. Here's what I see happen often. People start the wheel because it looks simple, but over time they realize there are a lot of potential pitfalls. What stocks are actually safe to use the wheel with? How do I avoid earnings blowups? What happens if multiple positions get assigned at once? How do taxes affect real returns? When do I roll, close, or accept assignment? And the biggest one, the wheel could quietly turn a concentrated stock portfolio during market stress. That's usually when investors start thinking, maybe I don't want to manage this alone. When managed properly, option premium strategies can absolutely have a place in a diversified portfolio. But professional oversight helps ensure position sizing stays disciplined, trades align with long-term goals, risk is controlled during downturns, strategies are integrated with tax planning, clients don't overtrade or overconcentrate. The goal isn't weekly excitement. It's long-term wealth building. So here's the bottom line. The wheel's not a scam. It's also not magic. It's a tool. And like any tool involving risk, it deserves respect. If you're running the wheel strategy and wondering, am I taking more risk than I realize? Is this actually helping my long-term plan? Would this be better managed professionally? Then it might be time to talk with an advisor who understands both options and portfolio construction. If you like a second opinion on your wheel strategy or want to explore income approaches with proper guardrails, feel free to reach out to us at WealthGuard Advisors. You can find my schedule at the link below. And if you found this helpful, make sure to like, subscribe, and I'll see you in the next video.